Let us be honest, 73% of Americans feel totally clueless about investing. And yet here is a surprising fact. The S&P 500 has turned every single dollar invested back in 1990 into $29 today. If you are tired of watching your hard-earned savings just sit there doing absolutely nothing while prices keep climbing higher, then you are in the right place. By the end of this video, you are going to know exactly how to transform your confusion into confidence using the exact 5-step playbook I followed to go from "I have no idea what I am doing" to "my money works harder than I do." So why even bother with investing? Inflation is the silent pickpocket of your wallet. Think about it. Last year's 3.2% rise means your groceries now cost more, but your checking account probably still shows yesterday's numbers. Investing is not a secret club. It is simply buying small pieces of businesses that grow faster than prices rise. Then there is compound interest, what Einstein famously called the eighth wonder of the world, which multiplies that growth over time. Start at 25 with just $200 a month in a low-cost S&P 500 fund, and by 65 you are looking at about $1.2 million. Wait until 35 and that number drops below 600,000. The lesson is simple. Time beats timing every single time. Let your money work for your future, whether that means a dream home, your children's education, or a comfortable retirement. Before you invest your first dollar, you need a solid foundation. Park 3 to 6 months of living expenses in a high-yield savings account. Think of that emergency fund as your financial airbag. It protects you from having to sell your investments when the market suddenly sneezes. Next, eliminate any high-interest debt, especially those charging over 8%. A guaranteed 20% return from paying off that credit card balance easily beats the long-term stock market average of 10%. A clean foundation makes for a solid house. Now that your base is secure, let us talk about where your investments will live. A brokerage account is like your personal shopping cart for investments. Great options include Vanguard, Fidelity, Schwab, or even a robo-advisor like Betterment. If your job offers a 401k match, contribute enough to get every free cent. That is an instant, guaranteed 100% return on your money. No match? No problem. Open a Roth IRA instead. You fund it with money that has already been taxed, and every bit of growth then comes out completely tax-free after 59.5. Prioritize these tax-advantaged accounts before using a regular taxable account. And always keep an eye on fees. Aim for costs below 0.2% per year. Fees are like termites, quietly eating away at your returns. Now for the fun part. For beginners, the smartest move is usually the simplest. Forget trying to pick the next Tesla or hot stock. Buy the entire market through a broad index fund or exchange-traded fund like VTI or FXAIX. That way you instantly own small pieces of thousands of companies, so if one has a rough day, the rest cushion the fall. This diversification is your best defense against market volatility. Over 30 years, 96% of active managers have lost to the S&P 500 after fees. So set it, forget it, and you will likely beat the pros. If you dislike volatility, add a total market bond fund. A 90-10 stock-bond split trims risk without killing your growth. You are ready for your first trade. It is easier than ordering takeout. Open your brokerage app, search for VTI, click buy, enter your amount, say $100, hit confirm, and you are done. You now own pieces of nearly every major United States company. To build the habit, set up automatic transfers from your checking account the day after payday, out of sight, out of mind. This is called dollar cost averaging, which smooths out the ride by buying more shares when prices are low and fewer when they are high. Do not worry about starting small. Whether it is $50 or $5,000, most brokers now allow fractional shares. The most important thing is just to start. Now automate everything and relax. Turn on dividend reinvestment so that every quarterly payment automatically buys more shares. boosting compounding. Rebalance once a year. For example, if your 90-10 split drifts to 95-5 after a stock rally, sell a bit of stocks and buy bonds to restore balance. After that, log out. Investors who check their portfolios daily earn around 40% less over 20 years because they panic sell. Markets rise about 75% of the time, but only if you stay invested. Your money is working. You do not need to babysit it. If this is making more sense than your high school economics class ever did, tap that subscribe button so you do not miss next week's video on the 3 biggest beginner mistakes to avoid. What about the biggest fears? What if the market crashes tomorrow? Crashes do happen, averaging about 34%, but every single one in United States history has recovered, usually within 4 years. Stay invested, and you will be buying cheap shares on the way down. How much do you really need to start? $50 is plenty. The habit matters far more than the amount. Is it too late at 40, 50, or even 60? Absolutely not. A 45-year-old maxing a Roth IRA at $7,000 a year could still reach $430,000 by 65, assuming 8% growth. The best time to start was yesterday. The second best time is today. Investing is not about being a genius. It is about showing up consistently, keeping your costs low, and letting time do the heavy lifting. Your mission is simple. Open an account, buy a broad index fund, automate your contributions, and live your life while your money quietly builds the retirement you actually want. Leave your biggest question in the comments. Hit like if you are claiming your first share this week. And remember the proverb, the best time to plant a tree was 20 years ago. The second best time is right now.